Hi, welcome back to Inside ETFs 2020. I'm joined by Shelly Antoniewicz. She's a Senior Director, Industry and Financial Analysis at ICI. Thanks so much for joining us today.
Thank you for having me. I'm really glad to be here.
So Shelly, you have a global worldview. So how do you think ETFs will fare in 2020? What do you think's in store?
Well, basically I'm going to see a continuation of the trend that we've seen in the last decade. So very strong demand for ETFs in the US, and that's partly fueled by adoption of ETFs by financial advisors, moving more of their clients' assets into ETFs. So one thing that's a little bit different in the data for 2019 was the strength in bond ETFs. So over $300 billion came into ETFs, and about half of that was into bond ETFs, new money. We would expect to continue to see that strength in 2020 and beyond as baby boomers age and tilt more of their portfolios towards fixed income.
And again, on new developments this year, do you think ESG and ETFs, that's going to be something that's going to develop?
I was on a panel for Inside ETFs yesterday on ESG, and there's been just a tremendous amount of interest in ESG, and it's continuing to skyrocket. So in 2019 alone, 20 new ESG-related ETFs were launched and came to market. And if you look at assets in ESG-related ETFs doubled in 2018. Now, one thing that came up on my panel yesterday and was very interesting is that ESG capabilities have completely expanded. And so if you roll back 10 years, it was primarily negative screening, just excluding stocks or companies that either didn't fit with, someone's values or social, environmental or governance concerns. What's happened now is we're moving more to an ESG integration process. And that can be something that's done by all funds, where they take into account non-financial information and how it can have a material financial impact on the company's bottom line.
And we're over 10 years now since a financial crash. There has been reform and things have changed, but do you think there's anything in the current system that has a cause for concern?
Well, when you look back at the financial crisis and you look at stock and bond funds, they really had absolutely nothing to do with the issues that led up to the financial crisis. And if you look at funds in particular, ETFs in particular, in the decade since then, what you see is that ETFs in times of stress have acted as a pressure release valve for markets. The ability for ETFs to trade in the secondary market means you and I can transfer our risk exposures really cost effectively, very efficiently, and we can do this when conditions in the underlying market are stressed.
So there's definitely some room to be positive this year.
It's a positive story for ETFs in that they do have this secondary market mechanism. I think lastly, though, it's important to remember that fund investors in general, mutual fund investors, retail ETF investors, they have very long investment horizons. They're saving for long-term financial goals like retirement, their children's college educations. So they sort of take these market events in stride. We've gone back and analyzed these historical, periods where there's been market stress, and retail fund investors react modestly, mild redemptions, and they kind of just, even when the markets are in turmoil, they sort of ride it out.
And Shelly, finally, do you have a controversial opinion for ETFs this year?
Oh, nothing controversial, but we do see strong growth in ETFs going forward and globally. So we think that Europe is a great place where ETFs have been going strong, but Asia is a very bright spot, and you see a lot of growth and interest in ETFs there.
Shelly, thank you so much for joining us today.
Thank you.